Hello, everybody, and welcome. Welcome to the Credo webinar, Bonds Are Back. For those of you that don't know us so well, Credo is a London-based independent wealth management firm founded around about 25 years ago. We have roughly 4.5 billion in assets under administration, spread across some 7,000 client accounts, and supported by over 100 staff members. In the past few weeks, there's been much news concerning banks and rates and inflation. So today's aim is to talk you through these issues and let you know how we manage money. Whilst there is much uncertainty in the world, interest rates have increased significantly, giving rise to a reasonably compelling opportunity to invest in bonds, hence the title of today's webinar. In today's discussion, I'm going to introduce you to the team. We're going to have a quick bond refresher. We'll discuss market conditions, and then our process, and lastly, our offering and performance. So I'm Rupert Silver. I've been in the markets for around about 26 years. The last 23 years, I've been at Credo, where I'm lead manager of the Credo Dynamic Fund and our fixed income solutions. Our chief investment officer is Dion Gous. He's been with us since 2012, following a number of managerial roles within the institutional side of the business. He has oversight of all our offerings. Our head of fixed income trading is Neelius Creel, and I'm going to hand you over now to Ben Newton to introduce himself.
Thank you very much, Rupert. As Rupert said, my name's Ben Newton. I joined Credo over 8 years ago. Prior to joining Credo, I was a discretionary portfolio manager at Barclays, and at Credo, I'm co-portfolio manager on the fixed income solutions, as well as Credo Dynamic. So I understand there's quite a varied audience to today's call, including financial intermediaries, professionals, and retail clients. For those of you slightly less au fait with what is a corporate bond, I wanted to give you a quick whistle-stop tour. So what is a corporate bond? A corporate bond is a loan between either a corporate or a government and a group of investors. That loan is defined by a contract, a legal contract between the two parties, which specifically refers to the interest rate the entity will pay and the maturity date. Think of it like a company going to a bank to get a loan or mortgage, but in this instance, they're coming to a group of investors, and they're doing so to diversify their lending base and because it might be a large amount of money. Moving on to how a bond fits in a broader risk profiles and how it compares to other asset classes. So on the horizontal axis, you can see the risk or standard deviation. And on the vertical axis, you can see the return. Cash is the lowest returning asset class. You don't expect to see volatility in the market value of your cash balances. Moving on, next to the right is developed market government bonds. I'm specifically thinking of United States or United Kingdom. They can print their own money and therefore they're highly likely to repay as the terms of the contract. However, you may see market value fluctuations. For example, of late, interest rates have risen, so bond values have fallen, and that was actually one of the contributing factors to Silicon Valley Bank collapse only a matter of weeks ago. Moving on to corporate bonds. Here there's a range of returns depending on the quality of company you invest in and the length of time you lend out your money. Finally, equities. Equities are expected to be the highest returning and highest risk asset class. As you don't have a legal contract defining your returns going forward, you get paid over the long term for that uncertainty, but you can see significant volatility and swings in the market value of your portfolio. Moving on to the two aspects of a corporate bond return. You've got firstly a government bond, and then you get paid an additional return for taking company risk. The graph in front of you shows the return you get, the interest rate you receive, lending out your money either 6 months on the left-hand side or 30 years on the right-hand side. I think it's interesting to note that for 6 months, the blue line, you get almost 5%, but for 5-year money, you get 3.5%. This is called an inverted yield curve, and it's not the norm. You would expect to receive a high amount the longer time you lend out your money, and so the slope would go from left to right. However, in this scenario, because interest rates have gone up so fast to deal with inflation, there's a significant amount of uncertainty. You have a downward sloping line. Moving on to the black line, corporate bond returns. I should say these are investment grade all dollar returns. The line's approximately flat, and therefore you get a small amount of additional return in the short term because you can analyze the company and its balance sheet. Moving out, there's a grey area gets larger because of a large amount of uncertainty in future returns and future company health. Moving on to credit ratings, bonds are typically rated by third-party agencies. You may have heard of S&P, Fitch, or Moody's. The best rated companies are AAA, and an example of that may be, for example, Microsoft, but there's only a handful of companies that have a AAA rating. This goes all the way down to C, where the company is actually in a bit of bother, a bit of trouble. In bonds, there's two sub-asset classes. There's investment grade, typically the better quality company, and they normally have a long-term track record and diverse in nature. Because of this, they're slightly lower returning and lower risk. The second sub-asset class is high yield. Here, companies are typically less diversified, smaller without that long-term track record, and therefore they receive a higher risk rating, and one, as a result, expects a higher return. At Credo, we focus on the middle ground of investment grade and high yield, as you can see highlighted in that box. Here, because the highest quality companies give a low amount of additional return, but the more risky you go, the more chance of a problem. So we focus on the middle ground, but having said that, we do invest in government bonds and A-rated securities, especially in our lower risk portfolios. Moving on here to what is the capital stack of a company and specifically a bank, because everything that's been going on in the press. Here, it's only relevant if a company, or in this case, the bank, gets into a difficulty, some kind of resolution scenario. Starting off at the top is the green, the senior secured loan or depositors. Again, the lower return, you get paid first in a difficult position. Moving all the way down to the red is equity tier 1 capital. Here, traditionally, we're thinking of a bank listed on the stock market. Why the Credit Suisse UBS transaction was so controversial is the next band up, the orange band, received nothing for their interests, while the equity tier 1 received some UBS shares. So this is not how you would expect it given the waterfall, and the European and UK regulator has distanced themselves from this decision. But importantly for everyone dialing into this call today, we don't invest in any of that bar additional tier 1 capital. We focus on the blue section. The blue section being senior unsecured and subordinated debt. That's again kind of a middle ground of risk and return. And even if we did own Credit Suisse debt, which we don't and don't own in any of our fixed income portfolios, you would have still received UBS bonds in exchange. So no haircut, no problems, but at the same time, we don't ever invest, or we haven't invested in Credit Suisse debt. So the difference between the two, senior unsecured and subordinated, depends on the institution and the risk profile of the client. Moving on to the key risks in investing in a bond portfolio. Firstly, credit risk. Here, we're talking about, will the company fulfill their legal contract as stated? Secondly, interest rate risk. What could I have invested? What return could I have invested if I invested at some point in the future? And what does that mean for the mark-to-market value of my portfolio, as illustrated by Silicon Valley Bank? Liquidity risk. In this scenario, we think that government bonds have the best possible liquidity of any type of asset class. However, corporate bonds can be less liquid, especially on the worst days on the market. Specifically related for our clients, we also aggregate to meet institutional minimums, and therefore there can be some delay in entering or investing, and if required, to sell down the portfolio. Finally, call risk. This is quite a nuanced area of the corporate bond market, where bonds can have a range of maturity dates. The best quality institutions pay at the first possible opportunity. However, this can depend on prevailing market conditions. We do invest in bonds which have a call date or call risk, and that's one of the ways we increase the return for enhanced yield portfolios. Moving on to market conditions. You can see here the graph shows US 5-year Treasury rates and US being in blue, UK being in black. Rates are the highest they've been for over 15 years. One of the best predictor of returns is the starting interest rate. And therefore, given we come especially from a very low base of COVID, where especially in the UK, rates were actually negative, we think this is an interesting time to consider investing in bonds. However, it's important to consider where interest rates are going. The graph in front of you shows the expectation of the market of where US which lead the world, interest rates are going between now on the left-hand side and in January 24 on the right. So it's been a volatile month. At the beginning of the month, rates were expected to gradually increase towards 5.5%, and I would say relatively level off, and maybe 1 or 2 cuts at the end of the year. We then had the chairman of the Federal Reserve come out and say they expected rates to be higher for longer, and so market expectations shifted upwards in the overall level of rates. But at the middle of the month, Silicon Valley Bank collapsed. Then interest rates are now expected to be cut quite quickly in the coming months and end the year around 3.75%. This is as a result of banks reducing their lending because they're kind of more of in a risk-off mode, and therefore interest rates in banks, the central bank, the Federal Reserve, to cut rates as a result. Since this, the Federal Reserve met last week, and they've tried to moderate some of the market views and saying they won't necessarily cut this year. So markets have taken that into consideration. However, the conclusion to this is you can see that rates have been very volatile this month. 2-year rates have actually been the most volatile they've ever been in a short period of time in the last 35 years. But for prospective investors or current investors, what this slide tells me is that I can see that rates are going to be peaking soon. Well, that's what the market thinks. Whether that's this month, next month, or towards the end of the year, we know we're close to the end of the interest rate cycle, which is a further reason to consider investing in bonds. Moving on to credit spread. Credit spread is the additional return you get for owning, in this case, investment grade bonds. Once again, in blue, we've got US dollar corporate bonds, and in black, we've got sterling corporate bonds. The data goes back all the way to 1990, and I would say the typical range is 1 to 2%, depending on the underlying market environment. I've highlighted above 2% because this is an area of interest where bonds, I think, give an attractive total return and attractive risk return. Typically, it only spikes over 2% for short periods and in times of stress, thinking the European banking debt crisis, Brexit, COVID, and in the UK's case, briefly at the time that Liz Truss was Prime Minister. Today, where are we in UK rates? Depending on the time I pull this data and I look at the graph, we're at or around 2%, and therefore we see some really attractive rates in sterling. For dollar clients, it's more like middle of the range, and therefore a reasonable opportunity, but not as attractive as sterling. Thank you very much. I'm now going to pass it back to Rupert to cover Credo strategy.
Thanks, Ben. Okay, I'd now like to move on to our process and our strategy. Firstly, a quick introduction to our mandate. Our objective is to produce a return above bank rates, but without taking undue risk. You have access to an experienced and stable fixed income team, and that team has a long-term track record through various business and credit cycles, including the financial crisis and COVID-19. During that period, we've had no previous defaults in the Credo Income Portfolios. Moving on to our strategy, this is something we've employed for about 15 years or so without change. Firstly, it's a buy and hold approach. We're not trading in and out of stocks. When we identify a bond, we aim to hold it to maturity. An important result of this is an investor knows in advance the return on each individual bond in the portfolio, and of course the portfolio as a whole, assuming that they hold it to maturity and there are no defaults, which of course would be our base case. We also like to use a laddered portfolio. What we mean by this is a portfolio with regular maturities, ideally each year. This has been really important in recent times as the portfolio has both income and capital flowing back in. So we've been able to reinvest at higher rates in a weaker market, smoothing the long-term volatility, much in the same way that pound cost averaging does for equity investing. It's also really important in times of distress that a client has the visibility of the credits they own and when they mature. And this is very different emotionally from owning a bond fund when that's falling. We like to focus on the crossover. Ben alluded to this before. Double B and triple B space, we think, and empirical evidence has shown offers the best risk reward over the long term. A portfolio only of A-rated and AAA rated bonds is very much a sleep at night portfolio, but it's not going to generate the returns that most of our investors require. And conversely, if we move down into single B or lower, you can get some great periods of return, but default rates increase dramatically, and it's too risky for us and our typical client. When we do want to take a little bit of extra risk for a client, and the mandate suggests we need to act to get higher yield, we like to go subordinated debt in higher quality companies rather than the higher ranking senior debt of a lower rank of a lower quality or a weaker credit. And this has worked well for us over the years. Going to quickly touch on our process. So there's quite a lot of bonds at the start. If we look at some individual banks, there's 5,000 plus bonds just for that individual name. So step one is using our Bloomberg to dramatically shrink this universe. To avoid illiquid situations, we filter for a 200 minimum issue size. And that gets rid of a lot of private issues as well. Then we move on to the screening stage. We're looking at both quantitative and qualitative measures and eliminate bonds that either offer inadequate compensation or have significant risks. And at the end of this stage, we've got a much more malleable worksheet where we begin our more detailed analysis. We'll then look through the balance sheet strength, the cash flow, and the profitability of the company. We'll look at the reputation of the issuer. This is particularly important on callable bonds. How have they treated their bondholders in previous years? We'll look at the terms of the debt, the interest rate sensitivity, and the debt maturity till we've got a much smaller list that we're very comfortable with. Lastly, we'll then build the portfolio. Our aim here is to diversify both across industry. We don't want to have all our eggs in one basket, but also across maturities to build that ladder portfolio that we discussed earlier. And then ongoing, there's monitoring and analysis throughout to make sure all constituents of the portfolio remain both attractively valued and viable propositions. So now on to our offering. We've got two risk profiles, each in two currencies, so there's four portfolios. A conservative yield portfolio on the left, we describe this as pretty bulletproof, very much a sleep at night portfolio. And then on the right, you've got the enhanced yield. Clearly, we take additional risks here to get the higher return, but note this is still an investment grade portfolio. Breaking them down slightly, you'll see the first line is the yield. I should stress this is before our fees. You'll see in sterling, the conservative yield gives 5.25 and 5.43 in dollars. The enhanced yield, 6.73 in sterling and 6.20 in dollars. And then below that, I've got some example companies. I'm sure you will recognize certainly most and probably all of them. Then we go through the little differences between the two portfolios. So the conservative yield has mainly corporate bonds, but also some government exposure. But the enhanced yield is corporate bonds only. In terms of ranking, the conservative yield is mainly senior bonds, and they're all bullet bonds. Bullet meaning they only have one maturity date. Whereas in the enhanced yield, we have mainly subordinated bonds, and some of those bonds will be callable, meaning they have a range of maturity dates. And those little tweaks are reflected in the ratings below. You can see the average rating for the conservative yield is BBB plus and BBB minus for the enhanced yield. So that's 2 notches lower, but both firmly in the investment grade space. Another way we can tweak the portfolios to enhance the yield is on duration. 2 to 3 years is the average duration in the conservative portfolio, and the enhanced we go out to 3.5 to 5 years. Both portfolios will have 10 to 15 positions, and I should also point out we have 2 tax-efficient portfolios for sterling investors that run along similar guidelines. In the light of the recent turmoil, I thought it might be useful to run through our financial exposure. Much of the press are talking about a financial crisis. Some commentators point out this is typical at the end of any cycle. Whether this is a crisis or not, or what type of crisis it might be, time will tell. But we want to stress our belief that this is not a repeat of the global financial crisis in 2007 or 8. The global financial crisis brought new rules for banks on reporting and capital buffers that make the 30 global systemic banks, or SIBs, much safer vehicles than in 2007. In addition, the losses that the banks have on the balance sheet is primarily in govies, as Ben referred to before, the mark-to-market loss. And this is very different from the toxic mess of 2007, all the leverage loans that they had in the subprime space. An area where we are less comfortable is the regional banks of the USA, such as Silicon Valley and Signature. We don't own any regional banks and have never owned regional banks. And that's because the requirements for these banks are different. They've campaigned long and hard to be treated slightly different. I imagine due to their smaller and less systemic nature. It means they have lower capital requirements, dramatically less risk management, and less contact with the regulator than the SIBs. And we do have concerns, therefore, that more regional banks might get into trouble. Secondly, banking is primarily about confidence and trust. So we don't and have never owned trouble banks, for example, Credit Suisse. Credit Suisse has faced scandals and outflows for several years now, be it associations with money laundering, huge losses on the Archegos situation, restatement of financial statements. And of course, Credit Suisse got into trouble this year, but it wasn't profitable in 2022 or 21. So there's plenty of good banks to choose from without having to look at more troubled names. So what do we own? Well, a majority of our names are globally systemic banks, these 30 SIBs we discussed. They have strong capital ratios, strong liquidity, and diversified depositors, both across industry and geography. And in the interest of transparency, I've listed all the names we own in our 6 portfolios, if you're including the tax-efficient portfolios. Bank of America, Barclays, Citi, Goldman, Wells Fargo, and Investec. All bar Investec are SIBs, and Investec we think is a very well-run company, offering a higher than usual yield, and it's a very good risk-reward situation, in our belief. Some other portfolio information. With regard to fees, it depends on what type of a portfolio you have and the assets within it. So for that, please speak to your relationship manager. In terms of minimum investments, to go for one of the core model portfolios, you'd need 250,000 in base. We also run segregated mandates, and we run quite a few bespoke portfolios. There's a minimum investment of 1 million in base, be it dollars or sterling. A bespoke portfolio might be for a longer duration portfolio, or perhaps a different risk profile. Maybe you would like to take more risk or less risk, or perhaps somewhere in the middle of our 2 portfolios. A really popular request at the moment is in government bonds, and we're seeing large flows here. It's quite clearly very appealing. And this, of course, is a part of the problem that banks are facing now. Both sterling and dollars offer short-dated government bonds of between 4 and 5%. For those of us that don't want to take credit risk, they can generate a return notably above banks whilst retaining liquidity. And in the UK, there's the additional bonus of being more tax efficient than bank interest. The next slide shows our performance versus the Barclays Global Aggregate Credit Index. The Barclays Ag is in black, and this is probably the most widely used benchmark for corporate bonds. In blue, we've got the Credo performance. And please remember, we run a wide variety of mandates, so this is an average of how they've all performed. Individual clients may have a different experience, but this is the average. You'll see over 10 years and 5 years, 3 and 1, we've outperformed in differing market conditions. And this is after our fees. We are particularly proud of the 1 year performance, falling dramatically less than the benchmark, some 8.6% less. And I think that's down to, firstly, taking a slightly shorter dated portfolio, but secondly, showing the effect of that laddered portfolio, having bonds return capital at a time of more distress and allowing us to reinvest at better rates. Just before I wrap up, a common phrase we've heard in the last few years is TINA, particularly from the equity teams. TINA refers to the fact that interest rates, or cash, and therefore bonds, have given no return in recent years. And in fact, there was a period where both interest rates and bonds gave a negative return. On this basis, it didn't really matter what was going on in the stock market. If stocks got a bit expensive, well, TINA, there is no alternative. If the economy started getting a little bit ropey and you were perhaps worried about that, TINA, there is no alternative. Well, I think that's changed now. And whether it's to get a return on cash idling in the bank, or perhaps to reduce the volatility of a more volatile equity portfolio, you do now have an alternative. Bonds are back. To wrap up, interest rates have increased, but so has volatility and uncertainty. Credo offers the opportunity to create bespoke bond portfolios for clients. We've got a stable and experienced fixed income team and a strong track record in navigating a host of market conditions. Bonds are back, but investors need to remain selective. With our expertise in the area, we remain confident in the road ahead and our ability to navigate the best rewards available for your risk appetite. That's it, really. Many thanks for your time. Please do get in touch with Ben or I or your relationship manager should you have any thoughts, questions, or you'd like to discuss further. Thank you very much.